right into it. So Jerome Powell said something delicious and juicy. He says, look, the whole point of higher rates is to tighten financial conditions. He says, quote, that's literally how it works. And so what's interesting is you've noticed Jerome Powell and the Fed been a little bit more fussy and maybe hawkish. And look at what's happened to financial conditions. This is the Goldman Sachs Financial Conditions Index. The Federal Reserve started hiking right around this region right here. You notice that these financial conditions really started relaxing and actually even relaxed during the banking crisis. A little bit of a spike there, but then a relaxation again. We are almost at the tightest financial conditions now, though, that we've seen following bond yields now at almost 5% for the 10-year Treasury, at the geopolitical risks that we're seeing, the lack of a House Speaker that we're seeing. Right now, the 10-year is sitting at 4.96% after that presentation. That's up slightly. Oil's up slightly again at almost $92. These are some expensive issues that people are very concerned about, and rightfully so. What's interesting, though, is Jerome Powell says he talks to businesses regularly, and he finds that the economy is strong. The consumer is strong. Where there's pain is potentially among smaller, more cash-strapped companies, early stage.
So the economy is strong, the consumer is strong, but the financial condition is toward the highs with that chart, right? This chart right here. So this is a bearish condition. You got to look at the overall picture. And, it's so difficult to sometimes see the overall picture because oftentimes you just looking at the short-term intermediate results, and it's positive in the beginning, gapped up. Here's the Jerome Powell conversation: initial down, then up, then down, then up. So during these moments, you can't make heads or tails whether they're gonna squeeze the shorts or it's a bull trap. So that's why you have to keep the overall picture, keep paying attention to the elephant in the room. And what's he saying? He's saying financial condition has been toward the highs, right? Financial instability, as well as the fact that Jerome Powell is saying the economy is strong and consumer is strong. So that level that leads to the objective of being longer rates being high or less rate cuts going forward. So keep that in mind.
How unemployment has not been under 4% for this many.
Unemployment, remember, the Fed has a dual mandate: inflation, 2%, maximum employment. So, like he said, employment is still good, yet inflation isn't as where the target should be. So that is a negative. That is a bearish condition. You got to pay attention to the elephant.
Months in a row since the late 1960s. That's over 50 years, over half a century lows of employment that we're facing right now. Yet the economy is still moving and still chugging along above trend. Now,
I want you to take a quick look at this. Let's say if two talented traders bought Costco stock.
Jerome Powell thinks we might have to get the economy under trend to actually, and he says we're at trend right now with economic growth. He thinks we might have to get the economy below trend to actually reiterate we're not stopping until we get to 2%. But overall, so far,
not stopping until we get to 2%, right? That is key. He's going to continue talking hawkish and perhaps implementing policy outside of the Fed rate cuts, right? I don't know. Right now, it's pretty much 100% of no cuts in November. 75%. Once it gets to December, it's going to go to 70, close to 100. And even in January, it's still relatively of zero rate cuts, right? And the fact that the percentage of implementing rate hikes is so low, this is a bullish condition. But the elephant right now is still hawkish because he's talking hawkish, right?
A lot of wins. What about the banking crisis? People say, well, of course. They created the money printer banking facility for that, which basically said, don't worry, if treasury yields go up and your bond values go down, fear not, we'll still lend you money assuming those treasury bonds are worth 100% because we can always just take them and wait till maturity. We got time. That basically overnight solved the banking crisis. Really, really incredible. Now, what I really want you to think about that he said, which was, in my opinion, somewhat, there were two game changers here, okay? One that I'm about to talk about, and the second one that Nick T pointed out, which I also noticed in his speech. The first one is that he actually showed us his hand. He said something that a lot of people missed. It just went right over people's head, below their knees. He said it really clearly. He said, look, if people seriously expect that we won't stop until we get to 2% inflation, then we'll get to 2% inflation. Then he said, if people didn't believe us, we would never get there. And I'm paraphrasing now, but he basically said, if we came out and said we're done and we're not trying anymore to get to 2%, then bond yields would plummet, bonds would rally, and financial conditions would loosen really rapidly.
So that's a very critical point. And what he's saying is that people right now, investors are believing, of these probabilities of not having any rate hikes, right? Let's just assume this is like close to zero, right? And this is close to 100, right? So if Alan Greenspan, Jerome Powell continues to talk hawkish, but no one believes him, the market will continue to go up. Inflations will continue to go up. And if they don't believe him, then they won't get to 2%, which is the primary objective right now. This is why the market sold off today. Right? What he said is crystal clear why the market sold off today. Jerome Powell will implement whatever is necessary to get inflation to get down to 2%. Given that the consumer sentiment is still, I guess the consumers is still strong, the sentiment isn't that strong, but the consumer is still strong, spending is still strong, the economy is still strong, job is still low. So everything that is the second part of the dual mandate of the Feds is right now being met, but the primary or the first mandate of inflation is not being met. So essentially what that means is the Fed is going to implement or do whatever it takes to get to 2%. That means what investors are doing right now is not correct, right? So getting, the stock going up is inflation, the bonds going down is inflation. So he said pretty much he's I don't know how he's gonna do it, but pretty much he says the stock market needs to be a lot lower than what it is right now. That is what I'm taking from that statement.
And then we wouldn't get to 2%. So basically, even though inflation is going away, and in his commentary, in his prepared speech, his prepared remarks, he basically suggested there's a lot of volatile data. We have inflation coming down. Inflation was really great this summer. We had a little bit of a pop in September, but that's probably just volatile data. And we don't really have to be that heavily concerned about that. We have to keep putting on the face of strength until inflation's basically meaningfully on its way to 2%.
It is not the face. Trust me, it is not a face. There is things that I'm pretty sure the Feds can do that can bring inflation down or implement condition to bring inflation down sooner than later. Now, obviously, they could just continue to talk. Talk is cheap, of course. So if he just continues to talk and no one believes him, and eventually inflation will go down, maybe that's what they're hoping for. Who knows, right?
2%. Because as soon as we say we're done, bond yields plummet. And that makes it harder to get to 2% in the first place. So in other words, even though we're trending towards 2% and everything's going great, we still have to pretend like everything is bad Because if we stop pretending, then we'll unwind the progress we're making.
I don't think he's pretending. I think I don't know. I guess he could be pretending. Who the heck knows, right? But I mean, right now you gotta assume is a bearish condition just from what he's recapping what the Feds or what Jerome Powell is saying.
It's like a topsy-turvy world, but Jerome Powell is so clear about that. He is so crystal clear about that. There's no secret here. He's being very blunt and blatant about that. But everybody wants to forget that. There's this fear that there's actually still an inflation problem. There's not. And every inflation report that comes out, oh my gosh, there's a real inflation problem. There's not. Even in today's conference, Jerome Powell is very clear. Look, what caused inflation was a massive capability of demand coming at the same time as a supply chain shock driven by COVID. And even in countries that didn't print as much money as we did, they also experienced massive inflation because of these supply chain changes with high demand. But that's not what we have going forward. So he says we're basically on the trend to maybe even going below 2% inflation, just like where we were in 2012.
We're not going to below 2%, buddy. Not unless this whole stock market and the economy crash, GDP crashing. I mean, this needs to get down to, I don't know, at least pretty much, I would have to say, like down to this level, be lower to get below 2%.
Through 2019. We could go back to that.
No.
And if something breaks,
No.
we're not up against the effective lower bound. That's a big deal. The effective lower bound, the ELB, is 0% rates. It's basically a way of saying if you're at 0 and something breaks, how do you cut? You cut. The second big game changer was what he talked about labor. This is something that Nick T from the Wall Street Journal pointed out as well. And as I went through the transcript the first time, I actually wrote wow next to it twice. I'm going to read you this because it's the most important part out of the actual prepared remarks. In the labor market, strong job creation has been met with a welcomed increase of a supply of workers due to higher participation and a rebound of immigration. Many indicators suggest, while conditions remain tight, the labor market is cooling. Good. That means less of a wage price spiral. Perfect. Or no wage price spiral. Job openings have moved down from their highs and are only modestly above pre-pandemic levels. That's a wow right there. In the past, he used to say, we want 1-to-1. Now he's like, yeah, we're only modestly higher on the jolts right now. This isn't that bad. We don't need to go to 1-to-1. He's basically undoing what he previously said. He's flip-flopping. He's like, nah, 1-to-1's not that important. We're okay being modestly above. Otherwise, he wouldn't say it's modestly above. He would say there's still progress to be made. This is good. That's a flip-flop from the Fed. What's another one? The one that Nick T pointed out has to do with inflation. And here it is. Quits are back to pre-pandemic levels. The same is true of the wage premium earned by those who change jobs. Surveys of workers and employers show a return to pre-pandemic levels of tightness. In other words, remember how Jerome Powell is so worried about inflation coming from that third part. There are three parts: goods, housing, and then services x housing. Okay? Housing we know is coming down. Goods inflation is coming down. Put those off the shelf. What do you have left? Services x housing. Okay. What drives services inflation x housing? First of all, what is that? It's the person who cleans your teeth. It's the person who cleans your house. It's the person who does your tax returns, your lawyer, your funeral parlor. It's your veterinarian. It's your doctor. These are services. Okay, services x housing. Those prices go up when wages go up unsustainably. Jerome Powell basically here is saying wages are going back to what you would expect or would have expected pre-pandemic. What inflation did we have pre-pandemic? 1.75%. We had below trend inflation. Right now he's flipping. He's basically saying, look, we're not really, like, between you and me, we're not really getting inflation anymore. Like, the inflation problem's done.
So essentially, he's saying that the salary workers' job labor conditions are not, are back to pre-pandemic levels. So if salaries and wages are back to pre-pandemic level, but the services like the house cleaners and the barbers and the dentists and if their services remains to be high, because inflation is sticky, so a haircut is now $25, right? Is that gonna be sustainable? Is that now if haircut for next year is still 25, that's no inflation, I guess. So it's tricky, right? Now, how do you interpret all this with the stock market? The second point of it, you really can't. There's nothing to it. It's just really saying that that's a bullish condition, from the prospect of Jerome Powell, being that wages are right now back to, and that is the tricky thing, right? Inflation is measured from year to year. So we have a surge in prices for goods and services and whatnot. Now that spike is done. It's a step function. Now these prices are elevated. It's not going to go back down. What they want is that the prices going forward to be the same or increase by 2-3%. That's a bad thing, right? So if a haircut is still 25 and next year is 26, 27, 28 going forward, that to me is bad because you get this step function of that one huge inflation, that happened last year or whatever. I think the Feds need to get a recession going, right? Will a recession happen? You know, come on, man. Let's get it happening. Let's get it happening. So the overall picture is, you know, an avalanche can happen, right? Things can snowball. One steps lead to another steps lead to another. That's how a market crumbles and fall really, really fast, right? If you look at this before, yeah, and these conditions were not even bad economically or financially, and all of a sudden it just gone really fast going down. And now it's not really going down that fast, right? Because this whole thing about the Feds, these are all forward, even though the condition here was so much better than the condition here, the forward looking here was that there were going to be a recession. And so people were selling. Now, there isn't a forward looking of a recession, but earnings is important, right? So what are we looking with earnings? I think Q3 is going to be okay, right? Forward looking Q4, we don't know. I mean, what's the price right now? It's going to have to be next week for Apple. I'm sorry, it was next week was Microsoft. What is Microsoft going to report? What is Google going to report? These guys are probably going to be decent, right? So is there going to be a rebound next week? Most likely, right? Most likely is going to be a rebound. That means, what are we looking at? We're looking at somewhere below this level tomorrow. Okay, somewhere below this level tomorrow. The futures is already this is the weekly, this is the daily. So I mean, I don't see anything right now that just say, hey, it's gonna bounce tomorrow because it should bounce tomorrow because we're at the 200, the 200-day moving average. That doesn't really mean much just because it's at the 200-day moving average, because you can backtest this and look and see that the 200-day moving average isn't anything special to where it's just going to bounce. The MACD is something that is pretty strong, right? When you're in a down condition and the MACD is going down like here, right? It's pretty strong as far as going downward or continue to go downward, right? So that MACD is a strong indicator that it needs to go to the negative. It needs to go down further. Yeah, this is the same composite. Right now, the composite, the MACD needs to go down. It's at this wedge. It can break the wedge. I don't see why it can't break the wedge. There's nothing special about that wedge. It's below the 100-day moving average, pretty much at this Fibonacci level. Yes, that Fibonacci level. Pretty much it's a little bounce at that Fibonacci level. So tomorrow is option expiration, but it's not just option expiration. It is the third week of the option expiration. That's the monthly option expiration. And puts has been strong. I have to admit, puts has been very strong. So you can see the volume on the put side has been very, very strong. So that that is telling me that the shorts are going to continue to attack. There's not enough strength for a squeeze. I get it that there were attempts at a squeeze today, right? There were several attempts at a squeeze today. They all failed. It ended pretty much at low of day. Okay, if you look at the after hours, it's pretty much end at the low of day for both the QQQ and the SPY. So that's a low of day end, right? So uh, when you get these low of day ends, like closing at the low of day, that is very bearish. And so it can gap down and continue to go down even further. That's the expectation. This is the weekly moving average on the 50. So when will it bounce? Somewhere tomorrow it can bounce, but it may not have to bounce. What is the there? I don't think there's anything in the economic front for tomorrow, right? Friday there's nothing, so it's a free day, and there may be some wobbling in the morning, like or the in the morning session, and in the afternoon session it's going to be a straight line down. It can happen, and maybe an end of day bounce or won't even bounce end of the day. It'll be closing the low of the day, and it can easily what we call a gap down on Monday. This is what you call capitulation, right? Fear. Like anybody who has tried to bot in or add to their losing position, like I said, anybody who was reading, there are a lot of all these channels right here were pretty much saying bullish thing, right?
8%, and we did break out of that range between SPY 430 and 437, and I told you this was going to be a very simple market to trade as long as you had a very well
It is not a simple market to trade. I mean, these guys are just their analysis are good, but they have objectives, right? All these stock channels, all they care about is subscribers and saying the right thing to bring in more subscribers and bringing in more people to pay for their services is all bullshit. It's really all bullshit. But their analysis are good, okay? Granted.
defined plan prepared for either scenario, and I still think that is the case. So the number one thing to pay attention to now is that I still do think that the favored scenario is going to be a Q4 rally, but a Q4 rally doesn't just go up in a straight line, and what we are likely getting now is this pullback before we continue higher.
No, this is not going to happen, okay? Just because you draw these lines and say that's gonna happen, no, it's not gonna happen. I mean, it's more likely to happen down here if you draw it down here, right? The previous video he said was how he's gonna do a gap fill toward the upper end. So now he's still pretty much bullish, right? Drawing these
Later
arrows
in
up.
November, we'll likely get another pullback until we fully reach that price target at 460. Now this
Ultimately, yes, he may be correct, but we don't need to look that far ahead. Like, why do we need to look at like the end of the year target? We just need to look at what is happening week by week, day by day, and adjust accordingly. And right now, day by day, I'm telling you, it is bearish, right? It is bearish until it's bullish. Tell me the data. Where's the data that's going to come in where it's going to flip the switch? I mean, is the bond not going to hit 5? I mean, why wouldn't it hit? Why won't it hit 5? It should, right? What else we got? What is the VIX doing? The VIX is high, okay? But it's not that high. It needs to go a lot higher, right? Why can't the VIX starts to go even higher? I don't see why it can't. right? I don't see why there isn't, and this is the start of I guess a MACD on the positive side, right? So why can't this thing just go much higher? Why can't we have a complete capitulation? I mean, the MACD on the 60 is pretty much broken, right? Everything is, it should have gone the other way, but now it's gone red. So ignore that. Pretty much, I am not seeing anything positive other than potential bounce point at these trigger lines or these technical indicator lines that may or may not sustain for more than 30 minutes, right? I just don't see it.
This is just the expectation while SPY is above a rising 200 daily moving average, and that is the last time we bounced on SPY was right there at 420, and now you can see that 200 daily moving average is still climbing and it's now sitting at 422. So for me, it is as simple as staying bullish above a rising 200 daily moving average.
Yeah, there's nothing bullish. Nothing bullish.
Going to do to companies, and more importantly, what's going on with Tesla. It got absolutely smashed over the last 24, some of the worst headwinds in a while. But with markets looking like they're facing some of the worst headwinds in a while, we also have to consider trillions of dollars of options expiration. Yes, maximum pain is coming in less than 24 hours.
Maximum pain is worthless, people. Don't even pay attention to maximum pain. It may matter at the very end. So yeah, maximum pain is right here. So I'm thinking maybe in the last 30 minutes, that is a potential bounce to help with this max pain, or whatever it is. There is no max pain as far as it's gonna get to this level.
Hours, and funnily enough, it's reached the zone we spoke about all week. Now, will we see
that zone is meaningless? That's what I'm keep saying. These zones
reach the zone?
These zones they don't mean anything. They're just, people are stuck in, I guess, like, oh, this is a zone. I guess. I mean, what is so important about this zone? There is nothing other than this 200-day moving average, right? Let me set the moving average for 200 on the simple. Let me see what the simple is saying. The simple moving average, and I'm gonna use let me use this color right here. Done. So I mean, I don't see a signal there as well. Right, this 200, this is 200 simple day moving average. So maybe the SPY is showing it. Okay, so the SPY has something there, right? So it's at the 200 EMA, and this is the 200 SMA. So that's a target. It's a target. That doesn't mean it's going to bounce. It's just a target. Just like this 200 EMA is a target, that doesn't mean it's going to bounce. I just don't see it saying this level and it's going to bounce. Means absolutely nothing.
All week. Now, will we see a switch? Well, with yields approaching 5 and, of course, Tesla getting dumped, we have a lot to discuss. Let's get into it together.
Tesla being dumped is a key economic indicator, right? This is a bearish condition. In fact, I had no idea why the market even opened up. This was just crazy. I think it was some number that came out today. Yes, so there was something that came out today that sparked an increase, and that must have been, let's look at the economic data. Potentially that's going to be something. Okay, so the initial jobless claims, is the jobless claims is weaker. The continuing jobless claim is higher. So this is a positive sentiment, right? So for the morning session. So I don't know if this is going to carry on. Let me think. Continuing jobless claim and initial jobless claims. So is that going to carry on into the back of investors' minds? The trend is going higher. continuing jobs. That's not good. Is that good? That's not good. That's not a good data. So U.S. continuing jobless claim is trending higher. That's not bullish. That's definitely not bullish. Or maybe it is. No, it's not. Because inflation, it needs to be a lot higher. It's not bullish as far as the economy is concerned. Initial jobless claim. Initial jobless claim is low. Okay, this is definitely not bullish as well. So I don't, obviously the reaction is favorably, and that meant that initially the stock market bounced here or here, but then eventually it's not. I don't think that data is going to extend into next week, into the back of investors, because this comes out every week anyway. So nothing there.
Right now.
And that Tesla information is a lot more important than, remember, this Tesla information, not Apple, Tesla. This is a sticky information. This right here wears on investors, right? This is not something that say, oh, they're gonna forget about it next week. No, Tesla is going to continue to be weak. That's gonna be negative for the stock market. So that's bearish going forward.
Well, welcome back, everybody. If you like button, 4.5% of stocks now remain above their 200-day moving average. This is not a level we've seen since November 3rd of last year. And you can check this out on our Twitter/X account in the links in the description down below. Another one, China holdings of US treasuries. You want to talk about sell-off massive? That's what's been happening now for quite a few years.
Okay, so this is the first time I've seen this chart. So he decided to put up this chart now because, it serves the objective of a bearish condition. But he was talking about how the Feds has been injecting, and this chart. This is a bullish position. He was saying how it's going to go up. Well, and now he's saying,
do we have a market that is incredibly freaking out? Well, a lot of us probably are, but Bullish Percent Index only posted its second loss in terms of the rally that we've seen so far off the October lows. And this is expected. In fact, it's expected we even come back to around this level. So what the bulls and the bears do here over the next session could really...
So he's really still bullish, right? He's saying this is expected, is going to... So everybody is still bullish for some reason. I have no idea why everyone is still so bullish. It's just mind-boggling how they can analyze these very complicated details. I mean, all these details, and they're still absolutely wrong in their sentiments. It's just mind-boggling.
On this level. So what the bulls and the bears do here over the next session could really dictate whether we're actually going into some kind of October rally for the rest of the month into November, December, or whether this is part of a capitulation sell-off and we have more problems than we can think about. I even heard that there was like a worldwide travel warning being put on the world at this stage. So we'll see how that all eventuates over the next week. Pretty scary stuff. Let's get over to sentiment. It is absolutely confused. In fact, all of us seem to be confused.
It is not confused. The sentiment is not confused, people. The sentiment is not confused. Don't believe these numbers. It is absolutely bearish. Okay, this is a bearish sentiment. This is why I'm bearish. And I continue to say it is bearish, right? The VIX is going higher. There is nothing confused about this market. I mean, I'm telling you now, when you get this type of low of day closing, right, on the SPY, okay, if you get a low of day closing with pretty high volume, there is nothing confusing about it. This is bearish to the maximum, the definition of bearish.
Went up a lot. Bullishness went down a lot, and bearishness actually kind of remained the same. Now, this is taken as of Tuesday, so of course things would have gone more bearish in terms of sentiment since then, but it's interesting to see how fast people switch.
I don't know.
Which, and you can
This guy is just getting confused with too much information. I think they're not keeping the eye on the elephant in the room, and they're getting distracted with too much information.
clearly see here bull/bear spread, and you track big thing to do was the the election maximum over the last 40 years with a pretty strong bullish week. It's pretty much been up. It's been
That's
up. Obviously, the
gold.
Friday was a
I
massive
don't care
squeeze,
about gold.
and we do tend to see a lot. 2.44
This is
times
the option. His
average
analysis and the options are absolutely incorrect. All these option analysis is absolutely incorrect.
Find out. We'll see how it all works, but that would usually be what I would expect. And therefore, there could be a good chance there is a rally, and a lot of that will have to do with structure that's formed over the futures market, and of course,
There is no rally, people. There is no rally.
Into the open itself. Make sure you're on the small time frames if you are a trader, and of course, always practice risk management is going to be key. Let's talk about percentage of stocks above everything. Percentage of stocks above the 20, bad, 28.19, 22, 29. Let's talk about yields. It was what I mean by that 2 years until we short date and the longer dates are getting closer and closer together. And that's thanks to, unfortunately, 5.1 trees did terribly. I mean, it was down 2%. Is really putting in the good around here. And a lot of that plays out. Copper sitting firm. Weird things. And in between that, it's talking about this level. And I would like to see the buyers commit. If they're going to commit, this is the time for bulls to get back into this market. Let's update the Federal Reserve injections. Now, Jerome Powell.
This Federal Reserve injection, I don't know where he's getting his data from, but it is not correct. I think he just puts this in there to make himself. He got 150,000 subscribers. So what he's doing, and he's obviously confusing a lot of people, including myself, by doing very expensive analysis across the board, right? This is 22 minutes of multiple, 25, 50, 100 charts, complicated analysis, details galore, data everywhere, including this Fed injection, but this is not a correct chart. This is just a eye chart to make it look like he's know what he's talking about.
Powell came out and said some weird things. And in between that, it seemed to be kind of egging the market on to take a US 10-year over 5. And of course, that led to what we saw, which was an increase in yields across the board. And there were a whole bunch of other things said.
The fact that this went down today, and he's using this chart as a Federal Reserve injection, I don't believe it. I don't believe it one bit. In fact, a lot of what he says is inaccurate. And you wouldn't know that, right? You wouldn't know that unless you're actually trading and doing your own detailed analysis and looking at what's going on, right? If you look at the options, there is a lot of options being bought up on these puts across the board. I was just seeing it. It's like there was just so much put options, right? And when there's that much put options, what happens is that at the end of the day, it starts to go toward 0 day to expiration, 0 DTE. So it goes toward the end of the day, and of course extended hours. Boom! It just started going down even further, right? So, tomorrow is option expiration, is the monthly option expiration, and these guys, they're not nothing. Like these guys who are participating here and buying, they're not they're not gonna just let it roll over and say, oh, I'm gonna let the longs take care of these options. No, right? They want to be richer, and they know the strength of the market is weak, and they know manipulation is strong, right? Traders, the market is a funny thing in that it doesn't really matters. Like, people think like the default is that up is the default, down is the opposite of default. No, down can be just as easy as up. So when you are a trader or a market maker or investors or whatever, moving it day by day, right? There is no reason why this level is a default to going up. It just doesn't work that way. There is no reason why just because it ends at the low of day that tomorrow is going to bounce. It can be another low of day. We have seen that, right? Low of day here, low of day here, and I guess there's a gap, but it went, like look at that, and you see that all the time. Low of day, low of day, low of day. So yeah, you can have another low of day tomorrow. Just because it's option expiration doesn't mean it's going to not reach toward low of day. And if I were to guess, I would think that yes, because it is the third, the monthly option expiration, there will be a bounce once it gets toward a capitulation, right? Maybe it's undercut this level, so maybe 30 minutes left, or an hour left, or whatever, right? 2 hours left, somewhere where it's, if there's a strong sell off, somewhere these technical levels are going to matter. I don't know where it's going to matters. If I guess, I'm probably going to be wrong. It could be, below this trend line, and that would be the SPY going toward, I guess it can touch this trend line. Why not? The QQQ, the composite. Why not get to this technical level right here? I don't see why not. QQQ toward, yeah, the QQQ is not as good as the composite. So the composite does have this, I guess, this trend line meeting up with this Fibonacci. So, and looking at the futures, right, it's below this level. What's the next significant level? Weekly, I don't know, right? It's hard to say, but somewhere here, I mean, that's so far away. This doesn't, there's probably other levels that's going to coincide, but the VIX is going to have to go a lot higher, right? So the VIX is probably going to have to go toward 25, 27 and a half before we get a bounce. That would be my guess. Is there any earnings tomorrow? I don't think there's any earnings that is. Yeah, I'm pretty sure there's nothing other than TSMC. No, TSMC should be after the close today. So let me see if TSM. Let's see how they did in their earnings. So I guess they released earnings prior, right? So this is a positive at least. So TSMC is a positive. Yeah. TSMC is a positive. There may be some other earnings. I'm not gonna look at it right now because I don't want to pull it up. But Tesla is still. I think the next catalyst has to be the Google and the Microsoft. So I would have to say I'm leaning positive going into this report. So I think it's Tuesday, if I'm not mistaken. Let me see. Is it Tuesday? The 24th, right? Tuesday. So yeah, I would say Tuesday. I would be starting to be bullish for Google and Microsoft, and and of course I can be wrong, so I don't know what to tell you because these guys can miss very easily. Can miss. That's the 10 to 24th, right? So why can't they miss? Of course they can miss. I don't see any reason why they can't miss, and that's going to be more bad news. So yeah, we can just be barely starting in this huge downturn that you're gonna see, and people already forgot all of this. I mean, I'm just surprised that all these analysis, they don't even remember these events where it's like huge red going down. So I'm not even sure if I should be bullish for that report of Google and Microsoft. I mean, I have to wait and really look into them and see, is there a potential for a bounce for them. I mean, right now I'm leaning for it, but I don't see anything why I should be bullish for at least tomorrow and Monday. So that's that.